Good evening, ladies and gentlemen. A very warm welcome to Finance Watch's conference on financial resilience in uncertain times. My name is Greg Ford. I'm a senior advisor at Finance Watch, and I'll be your host for this evening, for this event, which is itself hosted in this beautiful venue, courtesy of the National Bank of Belgium. Thank you very much to them. So the agenda for this evening, as you can see, is fairly straightforward. We've got two presentations followed by a panel discussion. Then there'll be a fireside chat with the Commissioner, closing remarks, and then, of course, the best bit of the evening, the networking drinks. So I should point out where the fire exits are. They are at the back of the building where you came in. If you hear a fire alarm, please follow the green signs and the ushers will take you to a safe place. There's no break during the program this evening, so if you need the loo, please feel free to get up and visit the loos, which are in the same place. If I could ask you to keep phones on silent, that would be much appreciated. And also just to mention that you may have spotted that photos are being taken, and I hope that's okay. If anybody struggles with that, please approach one of the Finance Watch staff members who are wearing blue lanyards, and we'll make sure that you're edited out. So the theme for today is, as you can see, resilience. And a few weeks ago, a senior central banker came to Brussels, Andrew Bailey, and he told the Econ Committee that in the financial stability world, success is when nothing happens. He also warned that risks are rising and that compound risks are getting particularly worrying, which is when several things go wrong at the same time. If you pick up a newspaper, you'll find one article on Iran, the next article on El Nino, which I'm told might lead to a global shortage of rice. The next article will be about the private credit market running rather hot. We've got the AI bubble. We've got possible excess leverage in the sovereign debt markets. There's an awful lot that could go wrong at the same time. So I think that today's theme of resilience is really on point, and I hope that it will stay top of mind for a long time after today's event. We are fortunate to have some very, very thought-provoking speakers here today to guide us through this topic. So let's get started straight away. To welcome you formally and to set the scene, please give a warm welcome to Finance Watch's Secretary General, Isabelle Buscke.
Dear Governor, dear Director Thiry, dear members of the European Parliament, dear Commissioner Albuquerque, representatives of the European Commission, representatives of member states and regions, dear representatives of civil society, ladies and gentlemen, good afternoon. It's not evening yet, but good afternoon. On behalf of Finance Watch, a very warm welcome also from myself to our conference on financial resilience in uncertain times. It's a pleasure to see a very full room because it's a very big capacity. And first of all, let me cordially thank our hosts, the Belgian National Bank, for having generously agreed to hosting our conference here today. It's an exceptional honor, and I thank Governor Pierre Wunsch for his hospitality and Director Géraldine Thiry. Thank you very much. As Greg Ford was already introducing, our topic tonight is financial resilience in uncertain times, and we'll hear later from our panel what financial resilience is, which ingredients are needed, and so on. Let me talk a little bit about uncertain times for a moment. Finance Watch was founded in uncertain times. After the disaster of the 2008 financial crisis, the economy was in shock. Once the dust had settled, the EU tried to fix its financial regulation. But policymakers were faced with fierce lobbying by those actors who were responsible for the crisis in the first place. A cross-party alliance of members of the European Parliament issued a call to civil society to create an expert voice that could speak up for public interests. Trade unions, consumer groups, environmental groups, transparency organizations, and many more followed this call, Finance Watch was born. We celebrated our 15th birthday already in April, but formally it is today. And I'm proud of all the work we have contributed and are still contributing. Finance Watch has been speaking up tirelessly for the public interest, and I'm honored to be serving now as its new Secretary General since January. Let me take you back for a moment to this year 2008. Ultimately, the reason why we are here as Finance Watch and why you are here at Finance Watch tonight. Britney Spears was playing on the radio. My home country, Germany, faced Spain in the final of the Euros and lost. And Beijing hosted the Olympics. Banks had been making historic profits. European banks' average return on equity had just reached 10%, catching up with the US, much like they did again this year. Some banks even made returns above 20%. Two of those were actually based not so far from where we are now. Does anyone remember Dexia and Fortis? I guess the colleagues from the Belgian National Bank actually do. And then came the financial crisis. Trusted institutions collapsed almost overnight. Names of banks most consumers had never heard of were sending shockwaves around the globe. We saw employees on our TV screens emptying their offices and handing in their badges. More than 30 institutions around Europe had to be rescued. Stock markets lost half their value between September 2007 and February 2009. The European Commission approved 5 trillion euros in state aid for the banking sector, some 40% of the EU's GDP, 40%. Of that, luckily, only 1.6 trillion euros was actually used. We got used at that time, to big figures, but let's break that down, what that actually meant. That is equivalent to more than 8,000 euros per household in the EU. That was the contribution. And if that sounds little to you, please bear in mind that the median net monthly income in the Eurozone in 2008 was just over 1,400 euros. So each household in the Eurozone roughly contributed half of their annual net income to stabilize the financial system. Much of the state aid was later repaired, but the real damage came from the Great Recession that followed, in which real household incomes fell further for 3 years straight, and millions of people lost their jobs. According to the World Bank, it was 30 million globally. 30 million jobs. An economy that had been growing 3% a year in 2007 shrank by 4% in 2009, a similar impact as the COVID pandemic that we might remember a little bit better. Much of this was caused directly by banks, on which the EU's economies rely, obviously. Bank lending to small businesses fell by 47%, and around 200,000 EU SMEs shut down entirely. That resulted in approximately 5 million job losses. Firms across the EU stopped hiring, pay was frozen or reduced. And then the Eurozone crisis followed. At one point, every second young person in Greece and Spain was unemployed. In the aftermath of these crises, many countries held inquiries to hold their financial regulators and bank executives to account, to try and prevent it from happening again. Blame for the banking crisis was attributed to subprime lending, complex derivatives, and excess leverage, but most of all to weak regulation. The result was the Basel III reforms, which increased bank capital and introduced new rules on leverage and liquidity at global level. The banking system is more resilient today, and we have not had a systemic crisis for years. But risks are rising again. We see more leverage and the re-emergence of opaque links to the non-bank financial sector. Finance Watch just published a report on this. We also see new risks from climate change, digitalization of the financial sector, geopolitical threats, creating the scary prospect of interlinked cascading crises. There is no room for complacency, really not. And it does not take much to imagine a financial crisis happening again. We hope the next one will be milder, but the truth is, no one knows how bad the next one might be. We don't know how the use of AI in banking might magnify a number of problems. Imagine checking your phone one morning and seeing that a financial crisis has started. What would you do next? You, the regulators, the legislators, the bankers. Fast forward to 2026. The big topics seem a little bit different than at the time. International competition and the EU's funding needs. That's what we read all the time in the headlines, specifically here in Brussels. But no matter how we approach those objectives, we must remember the lessons from 2008. A resilient financial system is the backbone of our economy, after all. Hence, I have 3 messages for you this afternoon. First, financial regulation is key for resilience. Second, finance should serve the economy, not just itself. Third, bank capital is vital for growth and resilience. Let me take them one by one. Financial regulation is key for resilience. The EU needs to be resilient in a lot of ways, not just financially, but also economically, socially, politically, strategically, and environmentally. Mario Draghi gave us some directions with his 3 Ds: digitalization, decarbonization, and defense. By investing massively in these 3 areas, 800 billion euros a year, he says the EU can preserve its competitiveness and strategic resilience. But investment at this scale needs financial markets that people can trust through thick and thin. Financial firms work hard on their branding, but what underpins trust more than anything else is the ability for strangers to interact with confidence, because they know that banks are backed by regulation and by supervision. If regulation and supervision are weakened, even a bit, we will lose trust and ultimately investment and resilience. At the same time, and I want to be crystal clear here, financial regulation can definitely be simplified. And Finance Watch has ideas to help with that. No worries, I will not list them all now, here, tonight, but just a few, and they include phasing out the most complicated part of the rulebook, for instance, the regulatory use of internal models for credit risk, a bit similar to what the US is currently proposing. I know it's not so fashionable these days to look to the US to copy things, but sometimes we need to give them credit where credit is due. Some other examples include reducing the number of capital stacks and simplifying the buffers and other components, or introducing a simplified regime for smaller banks. And for those who'd like a deep dive, you can read the full details in our response to the Commission's consultation on competitiveness of the EU banking sector on our website. Second point, finance should serve the economy and not itself. If growth is the objective, the most useful thing finance can do is to channel resources to the productive economy. Research shows that bank lending to non-financial businesses has positive growth effects, while lending for mortgage and other asset markets does not. But current data suggests that banks may not be focused on the right area currently. Loan balances to non-financial corporates and SMEs grew about 2.8% and 1.2% last year, respectively. That's hardly more than the inflation rate. Meanwhile, loans to financial counterparties grew between 3 and 8 times faster. The equivalent growth rates for loans to other non-monetary financial institutions, a category that includes hedge funds and private equity firms, private credit funds, and so on, was 8.5%, not just the inflation rate. Lending to investment funds and insurance firms grew more than 10%. So you see a pattern a little bit, right? This is good for financial counterparties, but is it really great for the rest of the economy? A few decades ago, I'm told, it was generally accepted that more finance meant more growth. Not anymore. academics have noticed that financial deepening, the amount of finance activity in the overall economy, does not have a linear relationship with growth. It follows an inverted U-curve, decreasing after a certain point. In all the latest studies on this topic, you can see that the EU is well past that point. And academics cannot yet say for sure why this is. Perhaps it's due to brain drain, resource misallocation, financial extraction, or the effects of crises. But the overall effect is clear. Too much finance is a drag on growth. What I take from this is if the EU needs 800 billion euro to drive productivity growth, as Mr. Draghi said, we should take care not to promote the wrong type of finance that pulls in the other direction. In our view, as Finance Watch, capital allocation should be part of how we measure the success of the EU's next round of banking reforms. For example, by monitoring how it changes the mix of financial activities and real economy financing in particular. As simplifications to bank regulation will need legislation, Finance Watch proposes that the European Commission takes a baseline measure of banks' capital strength now, 2026, and again after any changes are implemented, so that we can actually see and prove to citizens that the competitiveness and simplification agenda has actually done no harm, but what will be better is that it's actually positive. Third and last point, bank capital is vital for growth and resilience. My third message is in support of bank capital. Bank capital is an essential nutrient for the EU economy. It helps banks to increase their lending. Respected central banker Hyun Soo-shin looked at this when he was head of research at the Bank for International Settlements. He found that the elasticity of total lending with respect to book equity is very close to 1. If the objective of central bankers is to encourage greater lending, then equity is key, not more debt. If the EU now allows banks to reduce their capital strength, it will weaken the EU's long-term funding capacity. And that's actually squarely opposite to what policymakers are currently wishing for. So the good news is that banks can and should build capital organically from their profits. The more they lend, the more profits they make, obviously, the more capital they can accumulate, and the more, again, they can lend. That is what we call a virtuous circle. As we saw, European banks have reported record profits recently. The combined annual net profits of significant institutions in the single supervisory mechanism more than doubled to 178 billion euros between December 2019 and December 2025. So that engine seemed actually well primed. But there is an adverse incentive for banks to cut capital strength so they can pay out more in profits, which gives rise to a lot of lobbying in this town. This is a classic agency problem, and it's why bank capital needs to be regulated. The argument usually given for cutting capital is that it might increase lending capacity, but capital reliefs can be used to fund share buybacks and dividends, or to increase non-productive lending, which we've seen is already growing quite fast. There is no guarantee. On the contrary, strong counterindication that capital reliefs will benefit the productive economy. Hence, the trade-off is not between lending and capital. It is between lending and shareholder remuneration. I understand that banks want to pay more to their shareholders, but given the turbulent times we're facing, that actually seems a terrible idea. The result could mean shifting risks onto taxpayers if things go wrong again. That is not how market economies should work, at least not in our view. Ladies and gentlemen, in these times of trade wars and real wars, of wars on democracy and on climate action, resilient banks are a life insurance for our way of life. The EU can ill afford a financial crisis, particularly now, economically or politically or in any other way. To uphold our way of life, our focus must be elsewhere. We need that backbone and we need that resilience. We need simple and strong financial regulation, and we need a financial sector that serves the real economy and not one that focuses just on shareholder remuneration. A resilient financial system serves us all well in a world of mounting uncertainties. It starts with well-capitalized banks, and it continues with the ability to absorb shocks, be they from a changing planetary climate, the need to transition our economy, or the unpredictable risks linked to the use of new frontier technologies. With this, ladies and gentlemen, I would like to hand back to our moderator, Greg, and I'm looking forward to the discussions tonight here on stage and afterwards. Thank you very much.
Thank you very much, Isabelle. Our next speaker is a director of the National Bank of Belgium, and has not had to come very far to be with us today. Géraldine Thiry is responsible for bank resolution in Belgium, which is a role to which she brings a very refreshing viewpoint, as we will shortly hear. She also attends the Single Resolution Board for the rest of Europe, and she's responsible for the bank's data and statistics. And she represents the NBB at international bodies on statistics, national accounts, and integrated reporting. Besides being a central banker, Madame Thiry has a distinguished academic career as well. And she is a member of the Royal Academy of Belgium and a professor of economics, which she teaches at the University of Louvain. Ladies and gentlemen, I'm delighted to introduce our keynote speaker for the evening, Madame Thiry. Press the button.
Thank you very much, ladies and gentlemen. Good afternoon. It's not still the evening, as Isabelle said. So good afternoon. Maybe before I start, I would like to warmly thank several colleagues from the National Bank of Belgium who have contributed to the reflection for the speech today. Grégory Nguyen, Anna Hen, but also Alexandre Francard, Alexandre Ginster, and Patrick Van Roy. I'm also grateful to the organizers and to Finance Watch for the opportunity to speak today. Thank you very much. Today, as was said in the opening address, the European financial policy debate is full of simplification. Simplification has become a dominant mantra. Banks and policymakers increasingly argue that rules have grown too complex and should be streamlined to support competitiveness and growth. This idea is now widely shared, including the public authorities. The European Commission has made simplification a priority. And even the European Central Bank has set up a high-level task force to make regulatory framework more effective. Though, and to be clear from the outset, there is a broad agreement among supervisors and central bankers that simplification is not deregulation. They stress that while streamlining certain processes, improving reporting efficiency, or removing genuinely unnecessary complexity can both be legitimate and desirable, they still argue that we should not weaken the safeguards that keep the financial system safe. For example, a recent high-level letters from several EU central bankers stated clearly that simplification should not be deregulation and that a resilient financial system is a precondition for a competitive European Union. The challenge is that the boundary between simplification and deregulation is often blurred. If the language of our debate constantly portrays regulation in a negative light, as a red tape, or as a bureaucratic burden, or as a regulatory overkill, we risk drifting into a mindset where cutting rules is seen as the default solution to any problem. In other words, even well-intentioned simplification can become a slippery slope towards deregulation if we are not careful. And this is precisely the issue that I would like to develop with you today. And why is there a risk of slippery slope? The reason is simple, because language matters. The cognitive linguist, Professor George Lakoffs, very well showed that the way we frame an issue, the metaphor, the narratives we use, this way of framing an issue shapes what people consider as common sense. When we talk about burdensome regulation, you see the image, burdensome regulation, excessive complexity, we are unavoidably activating a mental frame that envisions regulation as something onerous, heavy, unnecessary. And even if nobody explicitly calls for deregulation, if everyone uncritically repeats the simplification equals good mantra, we gradually reinforce the assumption that rules are fundamentally the problem. We imply that less regulation is inherently the path to a better economy. And as Professor Lakoff reminds us, when you argue with your opponent's terms, you often end up accepting your opponent's premises. So, if we let the debate unfold entirely within the deregulation as a burden frame, defenders of prudent rules, as the supervisors, as we are forced into a defensive crouch, struggling to justify rule against a presumption of guilt or presumption of inefficiency in this case. So a key issue from the perspective of the supervisory institution acting for the public good is to reframe the debate. The goal is definitely not to reject simplification, because there is room for simplification, but to ensure clarity. Robust regulation is not an obstacle to a good economy or a healthy economy. It's a foundation for stability, trust, and ultimately robust economy and financial stability. So maybe it's important, and you did it, and thank you for this in your opening address, Isabelle, but stepping back, it's really essential to recall why financial stability matters in the first place. A stable financial system is not an abstract objective. It underpins, as it was very well shown in the presentation of Isabelle, the functioning of our entire economy, and it serves key societal function. I will remind them very quickly because you already touched this point. First, a stable financial system enables payment and day-to-day transaction. It also safeguards saving and trust. It channels savings into productive investment when it's well reinvested in the productive economy. Banks transform deposits into credit and households for business. And the system also provides risk sharing and protection through insurance, hedging, diversification, allowing individuals and firms to manage uncertainty. This is why financial stability cannot be treated as a secondary objective or a constraint to economic growth. Stability is the condition that makes economic activity possible. Financial stability is a public good, and regulation exists to ensure these functions continue even under stress. In short, financial stability is not a constraint on the economy, it's a foundation. If we accept that financial stability serves a vital societal role, then the way we talk about regulation deserves reconsideration. Following Professor Lakoff's insight, let's deliberately, here for the exercise today, for the conference, shift the frame of this debate. And this is where I invite you tonight. For such a reframing, I will briefly leave the world of finance and turn to biology, drawing on the work of a French biologist, Professor Olivier Hamon, who developed a compelling concept, that of robustness. And I suggest that instead of viewing financial rules through the lens of a costly complexity versus beneficial simplicity, we recast the conversation as one of robustness versus fragility. The simplification narrative highlights efficiency, but tends to obscure the risk of doing too little. A robustness narrative, by contrast, emphasizes stability, trust, and continuity, and sees regulation as an enabler, not as a constraint. But wait, what is robustness precisely? Because I've spoken about robustness, it's time now to define what it is. And in Olivier Hammon's usage and definition, robustness is not just another word for resilience. It's complementary to resilience, it leads to resilience, but it's a little bit different. And let me now explain the difference. Olivier Hammon distinguishes robustness as the ability of a system to remain stable and functional despite disturbance, often by avoiding extreme crises, whereas resilience is the ability to bounce back or to adapt after a shock. So if resilience is about recovery, post-crisis adaptation, robustness is about building features that prevent many crises from happening in the first place and keep the system operating within safe bounds. But how is robustness built? Because I've said that it was a biology, so what has nature to teach us in this respect? Interestingly, the answer of nature to the question how is robustness built is through incoherence. Olivier Hammon shows that living organisms owe their robustness to certain incoherent elements within themselves, that is, deliberate imperfection, internal contradiction, tensions, redundancy, that counterintuitively stabilize their functioning. Let's briefly illustrate the main feature of robustness in biology so that things are clearer. First, robust systems accept, as I said, internal inconsistency. They tolerate opposing forces rather than trying to eliminate them. In biology, let's take the example of the cell division control. Cells in our bodies are governed by a signal that both promotes division, these are growth factors, but also inhibits too much division, these are the tumor suppressors. Or the nervous system. Brain activity depends on a balance between excitatory neurons that stimulate activity and inhibitory neurons that dampen it. The key lesson is that stability comes from tension, not from perfect alignment. Second, robustness systems rely on incoherent feedback loop or internal brakes. Here, these are negative feedback loops that counter excesses. Think of the body temperature regulation. When your body overheats, it sweats to cool down. And when it's cold, it shivers to bring some heat. Stability comes then from continuous correction mechanisms. Third, robust systems in biology include redundancy, what we might call productive inefficiency. You deliberately allow a bit of waste or conflict so that the system can handle the unexpected. For example, consider the wasted leaves falling from the trees in autumn. They decompose and enrich the soil, thereby feeding nutrient back into the tree. This waste is not a bug. This waste is actually a feature of the system. Fourth, robust systems are continuously adaptive. Like the immune system, they evolve and respond to new threats, and we will come back on it in this world of uncertainty that we are precisely navigating today. Over-optimization for a single scenario, by contrast, would create fragility. In sum, the overall message is clear. Robustness requires accepting some degree of inefficiency, of complexity, and of tension. A system that looks slightly suboptimal in calm times is often one that survives the storm. In some internal incoherence, a dynamic equilibrium of opposing forces in inefficiency, is a source of robustness and of resilience at the end of the day in complex systems. It creates conditions for active self-correction. If one element surges, another checks it. Instead of a vicious circle, the system runs on a kind of virtuous tension. This perspective shifts how we think about stability. Robustness is not static. Robustness is not something free. It's earned by designing the system with slack, buffers, and internal contradiction that can absorb the shocks. With this biological understanding in mind, let's come back now to the financial world. We can now return to the finance and ask whether the post-crisis regulatory framework reflects these principles. When viewed through a robustness lens, many features of the financial regulation actually are often criticized today as too complex, appear instead as deliberate design choices. Bank supervision and bank resolution are very good illustration of this logic, and as a central banker, I found it's a good example to go and to dive into this illustration. First, as I said, robustness relies on internal brakes, incoherent feedback loops. In biology, as I said, feedback mechanisms prevent uncontrolled expansion, and in banking regulation, capital requirements, leverage ratios, liquidity constraints play exactly this role. They may appear inefficient from a narrow short-term profitability perspective because they limit leverage, maturity transformation of risk-taking. But precisely for that reason, they prevent self-reinforcing dynamic that can destabilize both institutions and financial institutions at the end of the day. The same logic applies to macroprudential buffers, such as the counter-cyclical capital buffer. During good time, buffers are gradually accumulated. During stress periods, they can be released. This reflects another robustness principle, the capacity to continuously adapt rather than seeking a fragile equilibrium. Resolution tools play a similar role. They stop crises from escalating by intervening decisively when a bank is failing or likely to fail. I have also mentioned that robustness requires redundancy, what might look as productive inefficiency. In nature, as I said, robustness often comes from the existence of backup mechanisms and multiple pathways. Resolution frameworks apply exactly this logic. The MREL requirement, for example, ensure that the bank maintain loss-absorbing and recapitalization capacity before a crisis occurs. From a purely efficiency-oriented perspective, this may look costly or excessive. But from a robustness perspective, it creates room for maneuver when shocks materialize. And it's particularly relevant in the uncertain times of today. Finally, robustness also depends on counterpowers and collective coordination. Supervision and resolution are inherently collective framework. They recognize that the stability of the system cannot rely solely on market discipline or on the optimization behavior of individual institutions. Resolution colleges, cross-border cooperation, macroprudential authorities, and supervisory coordination mechanisms all act as institutional counterpowers that help avoiding destabilizing dynamics and short-term incentives dominating systemic resilience. Finally, robust systems are not static, they adapt. Our frameworks, as supervisors, adapt as well. We integrate new risk, from climate to cyber, as was said by Isabelle. We refine stress tests, resolution planning, supervisory practices. Robustness is not a fixed state. It's a continuous process. And this leads me to the evolving threats and evolving world in which we have to navigate today. Because robust systems are not designed once and for all. As I said, they evolve as risks evolve also. And this has a direct implication. Financial regulation itself must adapt. If we look back, the post-2008 framework was designed primarily to address financial risk, credit bubbles, bank runs, contagion. And in that respect, as was said by Isabelle, it clearly delivered. Stronger capital and liquidity buffers, together with resolution regimes, have made banks much more resilient. We saw this during the pandemic, and again, in the 2023 market stress episode, European banks remained broadly stable. But the risk landscape is changing. Today, some of the most significant threats come from outside the traditional financial channel. Cyber attacks that can disrupt operation overnight, geopolitical shocks that can trigger sudden dislocation, or climate-related events that can affect both infrastructure and balance sheets. And these risks are different in nature. You cannot fix a cyber attack with capital buffer. A well-capitalized bank can still be brought to a standstill, if its systems are compromised. So the response should not be to roll back regulation, it should be to adapt regulation and to extend it where necessary and simplify it where necessary. This is already happening. Supervisors are developing cyber resilience stress tests and putting more emphasis on operational continuity. Resolution authorities are revisiting resolvability to ensure that banks can be managed under extreme operational disruption when data or communication systems are impaired, for instance. At the same time, we are also recognizing the limits of the existing tools. And behind the question of the tools is the questions of responsibility. There are new questions, the boundary between private responsibility and public authorities' responsibility. This opens to a huge range of discussion about our new tools for regulation. Against this backdrop, calls for deregulation are not only misplaced, they are risky. Removing buffers or simplifying away so-called inefficiencies may improve short-term efficiency, but it reduces our capacity to cope with precisely the uncertainty that we now face. So let me conclude with a central message. The debate on financial regulation is not a technical debate. It's a deeply conceptual debate. If we frame regulation primarily as a burden, simplification will always appear the obvious solution. If we frame regulation as an infrastructure for robustness, the question becomes different. How do we preserve the system's capacity to remain stable under uncertainty? Robustness often looks like inefficiency in calm times. Buffers appear idle, redundancy seems wasteful, complexity feels uncomfortable. But history and biology teach us that these features are precisely what prevent collapse when conditions deteriorate. The challenge, therefore, is not to trim the fat, but to strengthen the backbone. You were speaking about the backbone, and this is precisely what has to be strengthened today. To preserve the buffers, diversity, and adaptive capacity that allow the financial system to continue performing its societal functions, even under stress and uncertainty. Simplification has its place, but only when it serves robustness, not when it undermines it. Because in complex systems, as our society, as our economy, what seems inefficient today is often what protects us tomorrow. Thank you very much.
Thank you very much, Madame Thiry. Could I invite our panelists to come up on the stage, please? Welcome to the discussion panel part of the evening. We are going to continue with the theme of resilience. and picking up on Isabelle's points about the importance of resilience for growth and for strategic autonomy, and also for the points from Madame Thiry and the lessons that we can draw from nature and biology. Particularly interesting, I thought, about the role of efficiency, something that we're often taught to think of as something which is always a good thing, but in nature perhaps it's not always a good thing, and we could learn from ecosystems that a bit of slack and a bit of flexibility, some redundancy, can be the difference between surviving a shock and not. I love that, plus the comment about strengthening the backbone. So we're going to continue the conversation from robustness, how to withstand a shock, into resilience and how to recover from shock, whether it's a financial shock or whether it's an external shock. And with me to discuss that are three experts in this topic with a wealth of experience. Verena Ross started her career in the Bank of England as an economist and a bank supervisor, and then became the first executive director of the European Supervisory and Markets Authority, ESMA, in 2011, where she served for 10 years and is now serving for the last 5 years as the chair. Welcome, Verena. Jonas Fernandez Alvarez is an MEP for the Socialists and Democrats. Jonas has a long experience in economics and finance, having worked as an economist in his native Spain, before being elected to Parliament 3 times? 3 times. And today serves as the coordinator at the Econ Committee for the S&D, where he's a full member and is also a substitute in the Budgets Committee. And Rebecca Christie is a non-resident fellow at the Bruegel, senior fellow. Stand corrected. Congratulations. Senior fellow at Bruegel, which is the Brussels-based economic policy think tank, probably needs no introduction in this room, where she writes and speaks about European politics, financial regulation, tax, and climate finance issues. Rebecca wrote the official history of the European Stability Mechanism and previously followed a distinguished career as a journalist, writing for Bloomberg News, the Financial Times, and the Wall Street Journal, among others. So welcome to all three of you, and thank you for joining us for this discussion. So today's event is all about resilience. And let's start with the basics. I'm going to ask each of you the same question. It's the one that I emailed in advance, so hopefully it won't come as a surprise, which comes in 2 parts. The first part is, what does resilience mean from your perspective? And the second part is our financial system resilient enough? Rebecca, Verena, would you like to go first? I think you need to, on the back, try that one.
Okay. Does that work? Yes. So first of all, thank you very much, and I'm very pleased to be here, and I'm very glad to see another 15th birthday, because ESMA also has its 15th birthday this year. So all good things clearly started in 2011. I also wanted to congratulate you on the choice of the topic of today, because financial resilience in uncertain times sounds like as topical as you can get these days. And certainly, coming to your question, financial resilience is really core to the European Securities and Markets Authority, because our mission is about ensuring markets are functioning orderly and helping to support financial stability. And our third part of the mission is investor protection, which I would argue also plays into that resilience. So I think it's really all 3 core aims of ESMA are very much around creating resilience. And if I look at what that means in practice, I think it really cuts across regulation and supervision. If we look at the European regulatory framework, I think looking back to where we've come from, clearly we've made important steps forward. And I'll come back to that in a second. But if I look at some of the things that we did, looking at OTC derivatives, for example, and central clearing, looking at some of the requirements around transparency in markets, and so on. And also maybe more recently, the whole framework around operational resilience, which in today's world with new technologies, I think is extremely important. So I think on the regulatory side, there has been a lot of work done, which I think has overall improved resilience. I'm sure we will come back to simplification and what Madame Thiry just spoke about, but let me leave it here for the time being. And I think on the supervision side, what is essential is really risk monitoring and making sure that we are aware of the vulnerabilities that are out there. If you look at the latest Trends, Risks and Vulnerabilities report, which we publish every 6 months, certainly risks, market risk, contagion risk, and operational risks are all at their highest level. So not surprisingly, this is something which we do worry about. On top of that, we have the technological change and innovation that I spoke about earlier. And I think the other point is that we live in such an interconnected world that we can't look at, risks just in isolation, because really what we are talking about is how these risks interact and how they also might move from jurisdiction to jurisdictions, whether that's within the EU or globally. Now to your second part, sorry, I'm being a bit long on, so how resilient are we actually today? I think I would say that if you look at the last month, year, and what we've gone through in terms of the geopolitical developments, the trade tensions, the market reactions to news flow, I would argue that actually markets have been pretty resilient throughout that. They've operated orderly. We've seen huge volatility, and nonetheless the infrastructure has held up and has operated and worked relatively smoothly. Is that resilient enough? I have to say, given the risk we are seeing out there, I have to say I would not want to put all my eggs into that basket and say, yes, we are wonderfully resilient and it will all be fine. No, I think we need to be very conscious that there are enormous congregation of risks out there, and therefore it's good we are more resilient, but I'm not sure that will necessarily prevent us from seeing another crisis at some point.
It's very nicely hedged, thank you. Jonas, what does resilience mean for you? Have you got the microphone working?
Yeah, that's fine. Okay. No, first, thank you so much for the invitation. Of course, it's a pleasure, to stay here to talk on these topics. In the last few months, and I am sure that during the next few months, we will talk more on these kind of issues. So it's a pleasure to be here. I was listening to Madame Thiry, and I think that with your new proposal on resilience, robustness, you say. No, I think that is even a better concept than resilience, as you explained, and I think that not to add many things on that definition, In any case, as an economist, when I think about resilience, what I interpreted by these words is that the framework by which our economies will be able to register a high potential growth. So the idea of the potential growth. When I studied economics, we analyzing the economic growth, the observable variables, the unobservable variables, and the output growth is something that we need to measure because it's not directly observable by the analyst. But I think that the framework by which we will be able to increase our growth, but in the medium term, the potential growth is at least what I have in mind. When I think about resilience, that is more or less the result of the robustness. So the effect is more or less the same. if we have to analyze the current financial system in Europe or banking system in Europe, as Verena said before me, I think that we are in a much better position than in the past. Yeah, not only during the last few months, also during the COVID crisis, we tested the resilience of our banking sector, and I have to say that we succeed, or at least we didn't enter in another financial crisis as we lived at the beginning of this century. Yeah, it's true that during the COVID crisis we put on the table also public support to the real economy. That is something that maybe we didn't do at the same level during the financial crisis in the first decade of this century. But in any case, the European banking sector suffered a difficult situation and a stress situation, also the supervisors, also the regulator, because we need to adapt the CRR, for example, through a quick fix that we negotiated very, very fast. So I think that it's clear that we are in a much better position than 1 decade ago. In any case, the uncertainty times we are living, we need to admit that we don't know exactly if the resilience we have will be enough for the future. Yeah, and by the way, we are in the process to implement the latest Basel recommendation, especially on the output floor. And we are in the transitional regime. So I think that we need to keep the current trend to implement the output floor fully, as we agreed in the trialogues with the council, and let's see if this is enough. Yeah, because as the title of the seminar said, the uncertainty times are very uncertain. Yeah.
Thank you very much, Jonas. Rebecca, the same question to you. Hopefully the microphone is working. What does resilience mean to you? The switch is on the back.
Thank you so much. Thanks to all of you for being here. Thanks also to the National Bank of Belgium for hosting us. I would say that resilience in general is a combination of being prepared and being flexible. So there is a certain element of make your own luck. One needs to do what one can to be in position to make the best of a given opportunity, but also to recognize that there are systemic forces in play, and that necessarily being resilient means being able to react and to shift gears. Many of us have experienced that in the job market, because the job market has changed so much over the last 10 or 15 years. You can prepare with your education. You can be ready to do a variety of things by keeping up with your skills. But if your entire industry has mass layoffs, you have to roll with that. You can't resist that or prepare your way out of being part of an industry that is no longer around. So in a financial context, and particularly for Europe, this means managing our preparation with our flexibility. And with regard to the redundancy and the ability to self-correct and repair that we heard about from Géraldine and Thiry, I would say we want to keep the redundancy that leaves us prepared, like the output floor that you were just hearing about. For those of you who don't remember the jargon, this is basically a baseline minimum amount of capital that banks have to have that is not fudgeable with models. Because in the iterations of the Basel process, one of the big differences between different jurisdictions is how much they allow financial institutions to use modeling and how much they just say, look, here's the line in the sand. If your model puts you below the line in the sand, find a way to get above it. So these lines are buffers. They are ways to be more prepared for things that we don't see. The flip side of that is one does, particularly from certain corners of the market, hear that preserving national complexity is a form of self-protection. And that is where I would say that may not leave Europe prepared for what it needs to have. If capital is ring-fenced, if workers are ring-fenced, if money is ring-fenced, then in a crisis, you can't get to what you need. And also in a growth opportunity, you can't get to what you need. And so that hurts the EU on both sides. And a thing that I'm very encouraged by is the European Commission's Market Integration and Supervision Package, which proposes really moving oversight to the European level, to improving ESMA to make it less beholden to national influences on its board, giving it more independence, and also more ability to coordinate and supervise at the EU level. If Europe can get this right, and that's a big if, but if the package is implemented in a way that gives the proper checks and balances to move all this up to the European level, then suddenly we have all these flows we can access, and those flows will help us become more resilient to what comes next. So that would be my beginning answer.
Brilliant. Thank you very much, Rebecca. And thanks for that first round of opening comments. I'm conscious that audience members have been in receipt of an awful lot of information over the last hour, so I'd like to just throw it open to the floor for a first round of questions, and then we'll come back to chat on the panel again. We've got a couple of roving microphones just about to start roving. If anybody has a question, I'll just take 2 or 3 to start with. Please raise your hand. And just before we start, if we could keep questions as brief as possible, please, that would be appreciated. Thank you. To this gentleman here, please. Thanks, Tom.
Hello. Thank you for everything you do and this wonderful meeting. I have just a question. What do you think about the digital euro? Thank you.
Digital euro. Okay, we'll take one more question from the lady in the middle there.
I just wonder how much the regulation is really resilient in the case what we see now is real concentration of the investment, and also the fact that actually in the investment industry, most of the investments of Europe are actually for US companies, and therefore money is going out rather than keeping it here. And I thought I don't think that's really a resilient model, and I didn't hear about it.
Okay, do we have a third question? One more at the back there, the gentleman with his hand up.
Hello, good afternoon. My name is Cristiano De Vergori, and I work for Euronext, based in Brussels. I have a question regarding, from a resilience perspective, what would be the right approach to address the opportunities and the risks brought to financial markets by new technologies, specifically in the context of DLT and AI? Thank you.
Okay, thanks very much. So we've got questions on the digital euro, on the concentration of investment going over to the US, and also on new technology risks and opportunities. Who fancies having a go at digital euro? You want to?
Thank you so much for the question. Yeah, in principle, in the Parliament last week there was a potential agreement, among negotiators to vote the proposal at the end of June and start the trialogues after summer. So I think that after many months with a long delays in the negotiation in the Parliament, finally I think that we are very close. Yeah, so now we are analyzing the compromises, and I think that we will be ready, to vote them at the end of June. In any case, I'm trying to answer to the question itself. At least from my perspective, the debate around digital euro is not just a debate around European payments means. At least from my perspective, or at least by which I think that we really need a digital euro, is a way to keep the monetary sovereignty in European hands. So now when we are seeing how other stable coins from other jurisdictions, other crypto assets are evolving in the markets. So honestly, we don't know if in 20, 30 years the monetary, the public money will remain in the market as they are currently, yeah, in Europe, in the US, in other jurisdictions. And I think that if the economy will evolve toward a more digital system, we need public money in the digital markets, yeah. And I think that no, the current proposal is more close to answer or to look for a European payment means, because most of them are not in European hands. So I understand the strategic debate that we are having currently on the digital euro, even more when we see what others in the other side of the Atlantic are doing. But at least from my perspective, the real debate is we really want to keep public money in our economies in the future. If the answer is yes, we need a digital euro.
Fantastic, thanks. So that's keeping that monetary sovereignty, diversity, resilience through diversity, if you like.
The capacity to manage the economy, the capacity to manage the cycle, to have a monetary policy. Yeah. So to have a truly monetary policy, we need consumers, households, companies use public money. Otherwise, we will not have any tool to manage the cycle, to keep the resilience or improve the resilience of our economy, to increase the potential growth, as I said at the beginning, yeah? And I think that this is the real debate, you know? Or at least there is one debate in the short term. So most of the means of payments are now in non-European hands. Seeing what we are seeing in the White House, to be completely transparent, no, it's clear that we need to promote European payment system. It's true that the debate or the necessity to have a European payment system does not mean that we need a public European payment system. No, in theory, with private payment system will be enough if the private systems are Europeans. But the issue is that we need public, because the debate is the nature of money. And the nature of money is we need public money, because otherwise we will come back to the 17th century. Yeah, so I think that now we live with our euros, with our dollars, with the money, and we think that the monetary system we have always has been there. Yeah. But if we analyze the history, most of the central banks were funded at the beginning of the 19th century to issue public money, because before of that, what we had was private money, and the private money is more unstable, created even more cycles and more bubbles than the current system. So the current system have many problems, but it's better than what we had for centuries until the foundation of the public money. And
a big step forward for resilience if we can get that done. Rebecca, do you want to come in on digital euro?
I would love to, actually. I love these questions, because the first question and the third question are kind of the same question. We need the digital euro in retail form, as we've just heard, and also the wholesale ways that's coming into being, in order to protect against disruptions from technology. We need a public anchor at all stages of the money chain, and we need to make sure that public money is fully interoperable with all the different ways the private sector is doing things. This can mean having a European retail payments situation. This can mean having interoperable bridges from the various chains of tokenized assets into the central bank system and out of the central bank system. This comes back to what I was saying earlier about having less fragmentation. If we have 5 different blockchain DLT standards that get adopted and they can't talk to each other, we could have the liquidity and we could have the collateral, but if you can't exchange it, you don't have a market. And this comes around to the middle question, which is, how do we handle investment, and how nervous should we be that we are investing outside of our own borders? And this is where I say we need to be flexible in our goals. And our goals are make money, be prepared for our future, and keep growing. To do that in this modern developed world economy, one has to engage with the US and the US investment system, because that is where the money is. It is a strength for European companies that need to scale up that they have the opportunity to go to America to get money. It will be great if we can give them places to get money here. That is wonderful, and we should keep doing that. But in the meantime, the answer is not to make it harder for them to go to America and get money. Likewise, for pension funds and insurance companies and big asset managers, the answer is not to lock them into a European market with fewer choices and fewer options. It's to facilitate a way for them to make the money to support our standard of living. I would refer you to research by my colleague Marie-Sophie Lapa, who just left Bruegel to go back to the European Central Bank, with various co-authors, including David Pincus of the Collar Institute. She has done great work on where are European pension funds investing. And they have drilled down, they have gone through the ownerships. And what they find is that there is still a home bias in these pension funds and insurance companies. They still invest in European assets more than you would expect given Europe's share of the world markets. And so, yes, we are sending money to the US, but on a strictly mathematical basis, European companies, investment companies, are still underweight the US. And maybe that's a strength, maybe that's a buffer. But it's I think, looking at the wrong risk to just say, oh no, the money is moving around. We need to think about what we need the money for, how to get it to grow, and how to make sure it's there when we need it.
Great, thanks, Rebecca. Verena, I think that leaves the third question for you, which was, should we be worried about the concentration of investment heading over to the US?
So I think I will follow a bit what Rebecca did and try to draw the three together, because for me, this is about how do we make sure that we have genuine alternatives and viable alternatives in Europe, whatever we are talking about, whether that is in terms of payment mechanism, whether that is in terms of the dependence and concentration when it comes to new technology, where we are also very dependent on the US, or whether that is when it comes to our ability to invest. And where do investors get the best returns? How do we make sure that our companies get the right funding? All of that requires us in Europe to make a fundamental step change to actually have proper alternative systems and a proper capital market that actually supports that. And for that, I would argue the first thing we need to do is break down some of the fragmentation that we still have in Europe, the barriers that we still have, because only then can we actually use the capacity and the positive side of what Europe has, which is a single market with a lot of consumers and customers, and with a lot of investors who are actually saving quite a lot. So there is money in Europe. It is more about making sure that that money and that saving actually works to move to productive investments. And so that is about getting the plumbing right. That's about making sure that our capital markets work properly. And in the new technology, that also means that we have the ability to use DLT technology, that we have the payments mechanisms that support that type of trading and capital market system. So for me, the three are absolutely interlinked, and it is all about how do we make sure that we have viable alternatives in Europe that make us less dependent and reduce the concentration risk that we clearly have at the moment.
I'm very glad that you raised the fragmentation point, and I think that raises an interesting question about where we go in terms of dealing with these risks that might fall between supervisory mandates, between particular markets, or between institutions. I'm talking about the generic risks that are coming in, perhaps from outside of the financial sector. Do you feel that we're ready for unexpected risks that might play across different parts of the financial sector? I mean, within ESMA, you have a very specific mandate. EBA has its mandate. Can things fall in the middle? What do we do about that?
So first of all, I think it's absolutely essential that when we look at risk and we monitor what's going on, that we don't just look in our own backyard, but that we actually look much more broadly. We do that proactively across the three ESAs very clearly, and also with the ESRB and in the European Central Bank. So certainly across Europe, we need to do that. And as interconnectivity grows between different parts of the financial sector, it's absolutely essential that we understand also how vulnerabilities are distributed, where potential risks could come into the system, and how it would translate across the system. And I would broaden it even beyond the European framework. We clearly need to also make sure that we discuss that at global level, because as the second question was pointing out, you know, we are not sitting here in isolation. Actually, we are very much dependent on what's also going on in the rest of the world. And so it's also about making sure that we have those conversations, that we get the ability to share data, that we do the analysis, and that we actually understand where risks might be coming from in the global sector.
So maybe some interesting developments on the institutional front in the future. While we're talking about supervisory mandates, Jonas, I did want to ask you a question about that. Obviously, financial supervisors, present company included, have a job to ensure the integrity and the orderly functioning of financial markets. But there's also a legal duty that supervisors have to consider the impacts of their own actions on the EU's global competitiveness. So that's a duty that's already in there, so-called Recital 13, I think it comes from. There are voices out there that would like to take this existing duty and turn it into something else, into a promotional duty that would require supervisors to facilitate the international competitiveness of the financial services sector. Now, I'm a Brit, and the UK had one of those duties in the run-up to the financial crisis. And to quote Andrew Bailey for a second time in one day, it didn't end well for anyone. So it was removed after the financial crisis. But for reasons best known to themselves, the UK government has recently reintroduced it. So my question for you is, do you think that the EU should follow the UK down this route of giving a promotional duty to financial supervisors?
The short answer is no. Yeah, but before no, but before entering on this debate, I would like to add something on the previous questions around the savings and investment in Europe. Yeah, the difference between European savings and how much the Europeans are able to invest in Europe, and the thousands of millions of euros who go to the States every year. I would like to introduce two ideas. Yeah, the first one is, in Europe there is enough savings. The problem is that there is not there are not enough investment projects to invest the European savings in European investment. Yeah, and the point is that given that there is enough liquidity in the markets currently, honestly, the problem is that in the real economy, as Verena said, we suffered an incredible degree of fragmentation. And I think that if we are not able to reduce the fragmentation in the real economy, we will see never a real investment project with enough yield to invest European savings in European projects. Yeah, so the point is that, okay, we need to fix financial markets, financial regulation, but I think that we need to focus the debate on the real economy, because the fragmentation in the real economy is even worse than in the financial markets. And the second idea on this debate is, okay, if we reduce the savings, the European savings, which every year go to the US, in that case, our deficit in the capital and financial account will be lower. And in that case, our surplus in the current account will be also lower. So sometimes in the debate, we split the discussion or the debates on the current account, our surplus in the current account, our deficit vis-a-vis with some jurisdictions, and I think that we need to analyze the two debates together, because there is an accounting identity between current account and capital and financial accounts, and the money that Europeans send every year to the US is the same as the surplus that we have in the current account. So I think that we need to have this in mind when we talk about these kind of issues. And finally, on supervision, I disagree with this proposal for many reasons. I remember in the 90s when we were debating the mandates of the ECB. Yeah, and there were many proposals to have two mandates in the ECB, the dual mandate, employment or growth and price stability. If we analyze what the ECB has been doing during the last decade or from the beginning, and we analyze what the Federal Reserve with a dual mandate have done, honestly, I don't see a real difference. I don't see a real difference about what the Federal Reserve did and what the ECB did. And in that case, the dual mandate, okay, is part of the political debate, but at the end of the day, it means nothing. And the second argument is that in the UK, the regulators and supervisors are also the legislators. So in the medium term, or thinking about potential growth or resilience, I don't believe there is any kind of trade-off between stability and growth. Yeah, in the medium term, I don't believe in this kind of trade-offs. But maybe in the short term, this trade-off could be occur. And this trade-off is a very political trade-off that at least in the European Union we decide through legislation. We decide through the Parliament and the Council trying to collect the opinion of the people. And in Europe, this trade-off is decided in the legislation directly. In the UK, supervisors approve the legislation. The Westminster, the House of Commons, the House of Lords, they don't legislate. They don't implement Basel. They don't implement solvency. So supervisors directly do that. And I think that in that context, okay, I can understand that supervisors in the UK, they need to internalize this trade-off in their work. But in Europe, this trade-off is internalized through the legislative process. Yeah. So in that case, supervisors, as I understand what they have to do, is to implement the legislation that we pass where the trade-off is solved.
So I think we're very lucky because we've actually got a former UK supervisor sitting here. I wonder if you have an opinion from those days when you were at the FSA working under that mandate, and if you had an opinion about a promotional mandate for supervisors and the trade-offs that Jonas was referring to. Is that something you'd like to share some thoughts about?
I think it's the balance to strike for any regulator, and then the question comes, who actually is the regulator? And Jonas, I think, makes a very important point there, is to try to make sure that you, on the one hand, that you meet your core objectives. And so, to my mind, those should remain the core objectives of investor protection, orderly and stable markets, or whatever the equivalence is on the banking side. But clearly, you need to do that in a context where you recognize that you are not on this world alone, that there are other things going on out there, and that is something which you need to be conscious of, and the developments that are happening. So but that is not about conflicting or confusing objectives. That is about it being clear and obvious about that you are not working in isolation. And if I look at what the UK has done, and I think that's where also the kind of analogy breaks down to some degree, is the fact of actually giving real regulatory powers to the UK regulators and supervisors, which is something which in the EU is very much the prerogative of the Council and the Parliament, who then give the European supervisory authorities a very clearly defined, narrow mandate to provide some technical implementing rules. And that's basically it.
So if I were to put you slightly in a corner and say, promotional duty for supervisors, yes or no, how would you answer?
So first of all, I don't like this promotional duty way you phrase it, because I think what we are talking here about is the argument that there should be some consideration of competitiveness of the broader European system of the financial markets in terms of looking at that from a global perspective. So I don't think that's a promotion duty.
Okay.
I would draw a bit of a distinction here. So, but I'm personally believe you need to be very careful what you're wishing for. So I think in being a regulator and taking real important regulatory political decisions, I can see some rationale for it.
Yep.
But when it comes to actually doing day-to-day supervision, and actually even in the UK, it's about the regulatory duty. It's not about the supervisory duty.
Thank you. Now, I've got one question which I prepared for Rebecca about risk sensitivity. I'll ask you very as brief as I can, and then let's go to the floor again for some more questions. Rebecca, we've had decades of progress towards greater risk sensitivity in financial regulation. And where that's got us to now is a point where a lot of capital is calculated according to internal models and is then signed off by the regulator using those internal models generated by the firms, essentially their own management tools, the so-called IRB approach. Now, that's great for allowing firms to economize on capital, but as we heard from our earlier speakers, it might not be so good for resilience. We know it makes it difficult to compare firms, and sometimes it can lead to risks being underestimated. In the US, there seems to be a bit of a step back from risk sensitivity in the sense that the Fed is, well, you know what's happening.
Let me answer that with sort of 3 points I'd like to make. The first point is that Europe is now finding the balance between using models to suss out risk and using what we were calling earlier the output floor, using sort of a line to keep those models from going too low. And I'm very hopeful that this legislation that's moving through now will hit the right balance, because the last time the Basel Committee did an assessment of Europe, which was 2014 or something like that, in some ways, and particularly when it comes to capital measurement, the EU was seen as non-compliant because of these exceptions to the output floor. So Europe is moving in the right direction. Now, the US is recalibrating. As you know, the political situation there is very difficult. And I would only say that the proposals that we've seen from the Fed do seem to keep the US Basel compliant. So they may be less ambitious than the prior set of proposals, but to my knowledge, from everything I've seen so far, the US will remain in compliance with the Basel standards, which of course are an attempt to make the entire global financial system compatible and able to withstand a certain level of shock. The third thing I will say is competitiveness requires defining what risks we want to take. And it is not the risk that someone will steal your business. I agree with Verena, that promotional is not the way to look at it. It is the risk that your bank won't be able to keep up. And so by that standard, you want your bank to be well capitalized so that it can work better. It can run faster. You don't want to move the starting line for them. You want to put them in a situation to run faster. So I'm somewhat sympathetic to the sales pitches from some of the banks where they say competitiveness just means you need to look at all the new rules you put in and make sure we're not totally weighed down by disclosure and reporting and more disclosure and more reporting and the impact of these regulations. I mean, okay, sure. But really what the banks need is a strong and credible regulator, supervisor, that the rest of the world believes in so they can go out and do what they do. The US goes out and does what they do because people believe in the Fed. To a larger extent now than before, European banks go out and do what they do because people believe in the ECB. And to the extent we can give other sectors of the market, that asset managers, exchanges, other things, a strong and credible central regulator that people believe in, that makes them more competitive. We don't have to give an extra mandate. If the supervisor does what they're supposed to do, that will create a better environment.
Thanks, Rebecca. So I think we've got time for another round of questions. I can see the hand up in the middle there. Zoe's just on her way with a microphone. Do we have any other questions? There's one from a gentleman here and some more at the back as well. Could I ask you to just say who the question's directed at, please?
To all three panelists, I have a question about EU's Green Deal. Does it help financial resilience? Does it harm it? Or is it totally unrelated? Thank you.
Thank you very much. It's a Green Deal. The gentleman here.
I wanted to ask about your view on cross-border mergers as we have, it's all over the newspapers, but we still see very much national interest being put forward. So I wonder whether there like more competitiveness, more rules to foster like development of saving investment union, so on and so forth, is sufficient to move forward and to finally complete the single market also for financial services. Thank you.
I'm sorry, I'm not sure I completely understood that question. Are you referring to consolidation?
Yeah, in general, consolidation in the banking sector. I mean, it's still possible, but we still do see, namely UniCredit, Commerzbank merger being obstacled by national interest. So,
and your question is whether that helps or
yeah,
hinders
like in
resilience.
general, like what's your outlook for the future for the single market?
All right, thank you. And the gentleman at the back there, please.
Thank you so much. My name is Antonio Gambini. So I would like to throw two issues in the debate. First is an extra risk. We have been discussing lots of risks. There is another one, which is the problem of the possible change in the world dominance of the dollar, both as a reserve and as an exchange currency. So how do we evaluate this risk? What can we do about it? First issue. And then something which is a risk but maybe an opportunity, housing. So there is a huge housing crisis in Europe and in the world, and in Belgium and in the Netherlands, everywhere. And it's a big issue of social justice. People cannot house themselves correctly. And it's also an issue of, the transition to a green economy. And so what can the financial sector do to fix this problem? Thank you so much.
Thank you very much. So we've got questions on Green Deal, cross-border mergers, dominance of the dollar, and housing crisis. Who wants to tackle one of those?
Should do housing.
Can I ask you please to keep answers as brief as possible, because
Right,
our
I'll
next
start with
speaker
the
is
Green
already
Deal.
arrived.
The Green Deal gave birth to the EU's Sustainable Finance Framework, which was an attempt to push behavior through increased disclosures. We're now seeing a shift in how those disclosures are managed and required, and it remains to be seen if that will push the industry and European economy in the direction that the Green Deal had in mind. We also see that there's a split now between capital markets improvement, which are sector agnostic, and the clean industrial deal, which is all about getting specific investments into specific parts of the transition, like electrification and things like that. If we do it right, better capital markets mean more money to finance things we need for growth, like electricity, and it will work. If we do it wrong, then we'll have to try again.
Thank you. Jonas.
No, maybe first on the Green Deal, yeah. On the Green Deal, no, I do believe that the Green Deal is a real accelerator of our potential growth in the medium term, yeah. And from a financial point of view or financial regulation point of view, the issue is that we should internalize properly the climate risk, physical risk, transitional risk. During the negotiation of the last CRR, CRD, we did a real effort to give steps on that direction in the Pillar 3, in Pillar 2, and even we introduced some requirements in Pillar 1, given that at least with the current regulation on other industries, there are some activities that will end during the next few years because we ban directly some activities, and the assets related with that activities will be, not the value, the collateral value of these assets will be internalized properly in the bank's balances. So I think that the climate risk is something that is there and we should manage. And financial markets, what the financial markets do is manage risks, and climate risk is a new risk that we need to internalize, and the Green Deal also try to reduce these risks, and prepare our economy for the future. So I think that this is a key. The point is that maybe not all the people think the same if we see the result of the elections. Yeah.
So while you've got the microphone, do you fancy having a go at the consolidation question about bank consolidation and how this plays into the resilience piece?
No, I will not enter in a concrete merger or buying, because honestly I don't have enough information to analyze properly the operation. My point is that we need to change the regulatory framework to let this kind of mergers or acquisitions will go through the market forces without the current national ring fence that we see given the current national regulation. Yes, if we talked before on the fragmentation that we had in the real economy, in banking and capital markets, we also have defragmentation that our commissioner is trying to solve. So I think that we should not promote European champions because we really want big companies. The point is that what we need to do is to remove the national barriers, increase the size of the market, and let market forces define the size of the banks or the other financial entities freely. Yeah.
Thank you, Jonas. As we're reaching the end of our time, Verena, I think the last word goes to you to answer any of the above questions.
And I have to say a lot of them are about topics which I don't deal with very often as a capital markets regulator and supervisor. But what I think links some of them as well is this need on the one hand to break down barriers, as Jonas very rightly said, and making sure that actually we can have more interoperability across the European Union between market infrastructure players, and that we basically allow scale and liquidity to grow in and across the European Union and not be hindered by the barriers and the fragmentation that we still have. And clearly what is being proposed and what is being discussed under Savings and Investment Union is an important part of that. The other point I wanted to raise was really about the need to have our capital markets able to support the real economy and support the funding needs that Europe has, because we all know that banks alone are not able to do that. We all know that our fiscal capacity is constrained. So it is about trying to find other funding sources, whether that is to invest in a more sustainable growth into the Green Deal and changing some of our energy mix and all of that, or whether that is housing needs, or whether it is investing in new technology. It is really across the board, and it is about finding funding sources for companies in Europe.
Fantastic, thank you very much. And I think with that, our next speaker has arrived, and we're going to draw this to a close. For those of you that had questions that we didn't have time for, please come along to the networking drinks, and I hope that you'll have a chance to put those. Please join me in thanking Rebecca, Jonas, and Verena. Very interesting discussion. Thank you very much. So while the speakers are just leaving the floor, you may know that the European Commission and DG FISMA in particular is preparing a report on the competitiveness of the banking sector, which we're looking forward very much to seeing next month. But not only that, they're also busy with MBFIs and with a lot of other topics which are very central to our topic of resilience today. So I'm very pleased to be able to welcome in a moment to the stage the European Commissioner for Financial Services and the Savings and Investments Union, Maria-Louise Albuquerque, who will be having a one-to-one chat with Finance Watch's Isabelle Buscke. Isabelle, over to you. It's on the back.
Now, I did not follow the introduction earlier on. So, I'll have a second to go. Maria-Louise Casanova Morgado Dias de Albuquerque. This is what Wikipedia actually tells us, and this is a nice opportunity.
It's the Portuguese we keep, it's working? Yeah. We keep adding names, so It's the name of the mother, the father, the husband. We never lose any. We just add them. Trust me, filling forms can be a bit of a nightmare. And finding out the name they chose to register you in a hotel when that is the way to access the Wi-Fi. You don't want to have that experience.
Still, it's very nice. It gives me an opportunity to revive my rusty Portuguese that I used to speak 20 years ago. So you're the European Commissioner for Financial Services and the Savings and Investment Union. Thank you very much for joining Finance Watch here for a little chat between the two of us.
Thanks for having me.
So this is what you're doing now. I just looked up a little bit what you did earlier. In my welcome speech today, I recalled a little bit the events of 2008 and the financial crisis and what happened afterwards. So you were not far from all of this. First, between June 2011 and October 2012, you were Secretary of State for the Treasury and Finance in Portugal, followed by a short year as Secretary of State for the Treasury in Portugal, followed then by 2 years Minister of Finance directly in Portugal. In 2014, you had to make the choice to save the Portuguese bank Banco Espírito Santo. And this was around the time when ordinary citizens in Europe learned about their banks and their bad banks. This is something we don't talk too much about anymore. But I have a background in consumer protection, and talking to a lot of people, I have the feeling that ever since, a lot of people feel that they would love to hear that credit institutions have as much leniency with ordinary people as politicians had with banks at the time. There's a little bit of sense of unfairness that stuck from that time around. And that's the background for my introductory question to you. We as Finance Watch were celebrating 15 years today, and 15 years of ESMA, not here today, but it's a bit the same. And 15 years ago...
You're younger than the financial crisis then.
We're a little bit younger than the financial crisis, but we're a child of the financial crisis, because 15 years ago, the financial system almost brought down the entire European economy. And it triggered the euro crisis. You were in the middle of it. At the time, exactly, you were head of Issuing and Markets Department at the Portuguese Debt Management Agency. And what would be interesting for us is looking back for you at this time. What do you think did we get right after the financial crisis? And maybe also, was there anything that you said we should have done better?
A few things still remain to be done. So we are having it another go. But just also going back a bit in time, yes, when the financial crisis broke, the subprime crisis in 2007, and then the Lehman Brothers in September 2008, and then the sovereign debt crisis, which started in 2010. So I was actually in a very good place to watch these developments. And yes, it was brought about by the financial crisis, but it's not an accident that some countries went into a sovereign debt crisis and others didn't, because the financial crisis exposed situations which were unsustainable to begin with. Before the financial crisis hit, actually, it was possible to continue maintaining this unsustainable situation. Once the financial crisis hit, it was not possible anymore. And that is the background. So it's important that we understand the causes, because that was very important for the consequences and also for where all those countries who are under adjustment programs are today, which is actually a much better position than many others. So this is important so that we understand why things happened and what came out of it. So what we learned, or should have learned even better, but what we learned back then was that there is a link, a close link between the financial sector and public finances. Because member states raise debt, and that debt is raised with the financial sector, and a lot of it with banks. And banks, at the time, took risks, and we had all different situations. We had, just talking about the two most obvious ones probably, we had Ireland, where the banks brought down the public finances. There was not a problem of public finances. In Portugal, actually, the causality was the opposite. The public finances brought down the banks. And this is important for the banking union, which I will address in a bit. So the problem then was that there was too much risk in the system, or maybe risk not properly managed in the system. There were clearly supervision flaws, incapacities. There was this idea that bankers will not do wrong things, and everything will be okay, and this is just a phase. And the Americans let Lehman Brothers go down, and some of them regretted it because it was one of those major events that could have gotten completely out of control. Anyway, there are lots of lessons learned from those times, but one which emerged from first the financial crisis and then the sovereign debt crisis was that we needed to fix the problems in the banking sector in Europe, which were leading to the crisis. And that was the banking union. That is when we started, well, when the three ISAs were created in 2010, and then the banking union we started discussing immediately after. I was already in government, so I was at the Eurogroup and ECOFIN, and I participated in all these discussions. And the objective of the banking union, the ultimate goal was protect the taxpayers and break the doom loop between sovereigns and banks. Protecting the taxpayers, I think we did a really good job. So we have addressed the supervision problems. We have a single supervisory mechanism. We have the banking sector way more resilient than in the past. We have a single resolution fund. We have even improved recently the crisis management and deposit insurance framework that facilitates that banks are resolved rather than just liquidated or bailed out by the taxpayers. Now the single resolution fund is fully funded, so we've done a lot. But breaking the loop between sovereigns and banks, we still haven't done it. And that is part of the ambitions of the Savings and Investments Union project. It's about the common deposit insurance that will make sure that all depositors who have this European level defined guarantee of 100,000 euros per person per bank is actually not dependent on the capacity of specific member states to back that in case of need. But we also have the other side, or the other contagion mechanism, which goes the other way around, which is the sovereign debt exposure. So if a sovereign sells all its debt, or a big part of its debt, to the banks of that same country, what happens to one impacts the other. So it's that doom loop that still needs to be broken so that we complete the banking union. It's supposed to have 3 legs, it only has 2, and if it's supposed to have 3 with 2, it won't necessarily hold in all circumstances. So we need to do it. So we did very good things with the banking union, but we haven't completed them yet. So that's something to look forward to that I'm hoping we can start addressing in the banking report coming on the 15th of July, and then on the initial legislative proposals, which we will be tabling in the first quarter of next year.
Looking forward to hear more about this. Thank you for recalling a little bit also your own, what you draw from everything, because you were in the middle of it. You also, as a commissioner, emphasize a lot the link between finance and the real economy. And we've been talking about this in this room here also a bit earlier. And in my welcome address, I mentioned that the fastest growing areas of finance are not the real economy, actually. Or not to the real economy, sorry, but actually to the financial sector itself. And for example, bank lending to non-banking financial intermediaries is growing much faster than bank lending to non-financial companies. Is this, in your view, of course this is a bit provocative, but is this how the financial markets best contribute to European strategic autonomy?
Well, financial markets have more than banks. They also have non-bank financial institutions and capital markets. So the question, just like that, it's not necessarily a problem, because the money goes from the financial institutions to the non-bank financial institutions, which then pass it on to the real economy, because it's not in closed circuit. This actually is to provide other sources of funding for the real economy. So that description in itself is not necessarily a problem. What we need to guarantee is that we have a functional and complete financial system so that the corporate sector, the citizens, can find the best match for what they need. Maybe they need a bank loan, maybe they need private equity, maybe they want to go for an IPO. We need to make sure that all these alternatives are available, properly supervised, properly regulated, and efficient in the way that they give opportunities for everyone who needs the financial sector, because the financial sector does not exist for its own sake. Financial sector is an intermediary between those who have money and those who need money. Whether that's banks, non-bank financial intermediaries, or capital markets, or other players, it's not necessarily the issue. Of course, we need to understand better the non-bank financial intermediaries, because we have less visibility of the sector, and we are working on it to make sure that risks are properly managed. And we also need to understand why this is a preferred way. It's not necessarily for bad reasons. It might actually be something which has very good justifications. So the fact that the money goes from the banks to the non-bank financial intermediaries does not mean that it doesn't reach the real economy. What should be worrying us is the numbers that tell us that a lot of that money is actually going to the United States. And that should worry us, not exactly whether it's the non-bank financial institutions, but which real economy is it getting to? And apparently it's the American real economy. And that is because our financial markets are not working properly. That is also what we are trying to address under the Savings and Investments Union.
Thank you. You mentioned the right keyword as well for my next question. So because of the interlinkages between the capital markets, and also because, well, the Basel regime is at the G20 level, we often hear comparisons between other jurisdictions when it comes to regulation or supervision, when it comes to competitiveness or competition and such, particularly, of course, the United States. That's an obvious one. I mentioned in my opening remarks that we also know that EU banks are quite profitable at the moment, right? The dividends, the share buybacks are happening to a very large extent, and they're similarly profitable than their US peers. So the questions that we are asking ourselves, and I would like to extend to you, is should the EU set its own standards, or should it try to match those of other jurisdictions, knowing that their markets are different, and of course the jurisdiction, the legal system as well?
That is, I would say, the question of the moment, the one we have all been discussing. We have always been strong supporters of international standards. Actually, we are very active in all international standard-setting bodies because we believe there should be a level playing field internationally. We are an open economy, and we intend to remain an open economy. But obviously, we are very much aware of the issues of level playing field and the international competition. It's also important for us to understand who our competitors are. And linking this to my previous answer, yes, we are competing with the United States. And that's a fact. We are not competing among ourselves, or at least we shouldn't be. That's not the game we are playing anymore. We are competing with the United States. So it is important that we look at what they are doing at their rules and the impact it has on our own capacity, our own ability to compete, and our own standing in the world. That does not mean that we would follow them on a race to the bottom. But what we need to find is the right balance between preserving financial resilience, preserving the robustness and the financial stability within Europe with our capacity to be competitive. Because in the end, if we are not competitive, we will kill financial stability. Financial stability requires a well-functioning economy. Otherwise, it will bring us down. Or to quote one of my predecessors in a sentence I like very much, we do not want the stability of the graveyard. So we need to find the right balance. And that also requires keeping an eye on the international level playing field and seeing how we can adjust, given that we are no longer leading, and that is a fact. We need to understand the implications and find the right solution for us, keeping also that in mind.
Thank you, very clear. Earlier, we were speaking a lot about the simplification agenda, and you hinted at it just a little bit with the Commission report that we're all waiting for. What is your assessment of the simplification agenda so far? Like, have you identified areas that you can already share with us where we could reduce complexity a little bit without risking to shift the cost onto, well, in our case, what is of interest to us, citizens, consumers, taxpayers, in case an external shock cannot be absorbed?
Well, I would start by saying that the first impacted by the complexity are the consumers and the taxpayers, because who else is paying for the added costs? Us. There's nowhere else to get the money from. It's our pockets as consumers and taxpayers. So complexity is a burden that reflects on the prices we pay for the services and the goods we buy, and in the taxes we have to pay, because inefficiency has costs, and complexity translates into inefficiency. So simplification is, as you said, something that is very high on the agenda, because there is a common understanding that, yeah, our rules are too complex. But the point I have been trying to make, and just before I forget, do not expect to see quick fix simplification report on banking. That's not what we are working on. Yes, it will deliver simplification, because simple is usually better for competitiveness than complex. But what we are trying to put forward is actually looking at what should be the right framework for the banking sector of the future, that is both competitive itself and supports the competitiveness of Europe. Simplification is a part of it, but it's not the main driver of what we are doing. This is not a quick fix. It's a fundamental overhaul, looking again into the framework and understanding how should this framework be to support the competitive banking sector. And that involves simplification in the process. But simplification, actually, maybe we should start by all understanding why our rules complex. Well, it all starts with a proposal put forward by the Commission, which, point taken, it is not always as simple as it could be. But that's just where it begins. Then we go and engage with the co-legislators, with the European Parliament and the Council, so the representatives of the member states. And never, ever it happens that it comes out simpler than it got in. It's always more complex, especially because we try to create single rules with 27 exceptions. And then we complain it got very complicated, obviously. Then we take it to the member states level to be implemented. Then we have plenty of gold plating. If it's a directive, it ends all over the place. If it's a regulation, we realize that the same rule can be interpreted in 27 different ways. Then it is implemented in the companies, and boards decide to not take any kind of risk. So they impose additional rules. And auditors take every guideline as a binding rule. And compliance officers want to have 100% legal certainty, so they send thousands, hundreds of thousands of questions to our supervisors to have absolute certainty. Yes, it gets to be very complex, but if we want to make it simpler, we all need to do our part. We are starting that at the Commission, but if the rest of the chain doesn't support the effort, we will not deliver, because it's not just us. It's not just Brussels who is to blame. It is a shared responsibility. So that's what we are trying to do. And maybe going back to basics. Each step of the process, think, why are we doing this? What were we trying to achieve? What was the objective? Focus on the substance, not on the form. And take the risk of not complying with every single item of the checklist. By the way, the supervisors also need to be on board and understand it in exactly the same way. So it's a collective effort. It's not achieved by simply changing the way we propose things at the Commission. It has to be a collective effort. I think we have all understood the problem, so hopefully we will get there. It's going to take some time, but hopefully we will get there.
So that seems to resonate with the audience. I have two more quick questions for you. The dominating theme today, this afternoon, was uncertain times. And so there was a lot of discussion, of course, where this uncertainty comes from. External risks, mainly, growing ones, geopolitical, energy security, climate, nature, financial volatility, market bubbles, and you can probably, add some points to the list. Do you think we have been giving enough attention and paying enough attention to those factors or to robustness of the financial system in the past, also in light maybe of the first answer that you gave? And are we currently giving paying sufficient attention to resilience in a changing geopolitical time?
I would say yes. I don't think that resilience in the financial sector is the problem we have now. The problem is, how do we address all this uncertainty and this challenge? There is one risk we usually do not talk about, which is not taking risk. Not taking risk can be a killer. So we need to find the right balance. When we talk about uncertainty, we talk about the need to guarantee our own defense and security, the need to guarantee energy security, the need to guarantee that we continue to be autonomous to make our own decisions without depending either on third countries or big corporates from third countries. And that requires being competitive. That's what competitiveness means in the end, is our ability to continue to deliver prosperity and be strong and rich enough to make our own decisions. Because, if you are too poor, you are not independent. You will be dependent on what others decide to do and the impact it has on you. That is why competitiveness is even more important in this context. So yes, in this context, of course, we need to be aware of the growing risks around us and how is our financial sector prepared to cope with these increased risks. But at the same time, we need to promote the competitiveness, and that requires taking some risk. For example, financing innovation. And we always talk about the amazing innovative projects who made it. But there was a lot of money invested in those projects which didn't make it, because that's the only way you get to the success, is having a lot of failures along the way, which means that the financial sector needs to have the capacity to take that risk, to say, okay, I'm going to invest in 100 startups. One is going to make it. Do like the football clubs. They take on thousands of young kids who have some talent to play ball, because among them, from time to time, a Ronaldo emerges. And it is worth investing on all the others who will never make it for the possibility of having that one who makes it. That's the kind of spirit, forgive me for bringing this up, but the World Cup is starting and Ronaldo is Portuguese, so yeah. So that is a bit the illustration of the mindset I think we need. Yes, we need to take the risk of failure, because without it, we will not have the success. And that is exactly the kind of balance we need on the financial sector. How do you preserve stability and allow some more risk? Because the reaction after the great financial crisis, I think it was the obvious one. The pendulum was too much on one side, taking too much risk. So the normal reaction is taking the pendulum too far on the other side and saying, you will take no risk. And neither position is good. So we need to recalibrate. I don't think there is anything fundamentally wrong with our framework, by the way, but I think some recalibration might be in order also to adjust to current times and current challenges. And because we are very much aware of those challenges, we really need to find the sweet spot between financial stability and risk-taking capacity. And for that, we need scale, because scale allows for efficiency, scale allows for capacity to absorb risk, and scale on the financial sector, on the pension funds, on the capital markets, on the banks. We need scale. Financial sector is a network industry, and network industries need scale to function well. Small is beautiful does not apply here.
That could almost be the answer already to my last question. Finance Watch represents member organizations and individual members, and the members of our member organizations are also individuals, right? So we consider ourselves as the voice of society and of citizens when we speak about financial regulation. So if you had the opportunity to send one message to European citizens about financial stability tonight, what would it be?
Well, the first message is about financial stability or anything else is that everything we do at the Commission is for them. I mean, because if it does not help people in the end, then there's no point. No matter how sometimes it looks to be addressed to other points, it's all actually directed at improving the lives of our citizens. That's the ultimate goal of everything we do, financial stability included. The idea here is, and I know you represent consumers, and I'm always saying that when we talk about the financial sector, we probably should be talking more about retail investors than consumers, because it also empowers people. Giving them opportunities to put their money to work is different from being a consumer, and it kind of helps change a bit the mindset. My main message, would be, we are trying always, because we always need to adjust, to create a system where people's rights are guaranteed, a system where they can have trust, but also should provide them opportunities. And again, as in everything else, is about that balance we need to take. And people should also understand that taking no risk is itself a very risky decision, because it will certainly lead to losing value, namely on their savings. So it's about engage, look for information, try to educate yourself, because you are the first line of defense. A well-informed citizen is the best possible defense to fraud, scams, being sold inadequate products. No matter how much regulation and control we put, it will never be fully effective if each one of us does not take part of that responsibility onto ourselves. So engage, there's a lot of information out there, and a lot of entities willing to support that knowledge. So let us all engage, and let us all build trust collectively, because yes, we have made some mistakes in the past, but we have spent the last 17 years since the crisis trying to correct them, and we are still on that path. So I think the objectives haven't changed. It's just that we've learned something along the way, and we are trying to use that learning process to get to a better, fine-tuned result for everyone. But in the end, it's all about the citizens. So I'm really hoping that this works for the people.
Thank you very much, Commissioner. And before you leave, I brought a tiny little present for you. It matches her nationality, obviously, right? The Portuguese are known as the country of the navigators and explorers. Some of the most well-known were Portuguese. What is the indispensable item of a navigator?
Well, a compass, I suppose.
Correct. So I brought you... Wait. I brought a little compass for the Portuguese commissioner. So just in times of troubled waters, you stay on course for financial stability. Thank you very much.
That's very kind. Thank you.
Right. I think we took a little bit more of your time than what we promised, but I promise you that my closing remarks will be really, really short. A few things maybe that I would like to share with you about what I learned today is, first, I learned you actually learn useful things when you go to university. I read George Lakoff when I was in university, and wow, Director Thiry today explained a little bit to us why it's so important that we understand the theory behind framing. Second, what I learned, Finance Watch is ready to challenge the narrative, because when I took office in January, I brought Lakoff's most successful book to the office in sufficient copies for all the staff. Whoever of you wants to read up, it's called Don't Think of an Elephant. It's a warm reading recommendation. I thoroughly enjoyed the discourse analysis. Thank you very much for this. And I learned something else, I think, also in your keynote, Géraldine, is dear red tape. You can soon continue to wrap Christmas presents. Financial stability is rather like the robust foundation under the Empire State Building, right? It needs to be strong, but also a little bit flexible here and there. The panel, although I had to miss a tiny little bit of it, I think there was big conclusion from all the panelists that we've come a long way, and I think the Commissioner also just confirmed it. We've come a long way on financial stability for the last 17, 18 years. The system is more resilient now. I think I would conclude, don't change a running system if it's not absolutely needed. Lastly, I would like to warmly thank my team at Finance Watch for having done this absolutely stellar job here of putting together this fabulous conference. I hope you all enjoyed it as much as I did. And please join me in giving them a warm round of applause. To close, I would like to also thank all our speakers, starting with Director Thiry, Chair Ross, who had already had to leave, as well as MEP Fernandez, who also had to leave, Senior Fellow Christie, and Commissioner Albuquerque, obviously. Thank you very much for following our invitation and for all your interventions. It was very, very helpful, and I think it was very insightful also for everyone who attended. Thank you to you, our audience, for your interest, for your participation, for the questions, for coming in the first place and populating this very nice room. And now I have the pleasure to invite you to join us for a little networking drink and to continue the good conversations. Thank you very much.